Hello, this is Professor G. I decided to do something a little bit different with the Chapter 5 worksheet. I took this data out of the text on page 216, so these numbers will probably be different from your own. And then the next thing I did is I want you to assume that you're a manager of the marketing department. The managerial accountant has decided that the fixed expenses will probably go up about $10,000. And the variable expenses per unit is going to go up by quite a bit, $3.50. And so you decide that you probably should boost the selling price up to $65 per unit. You may be able to increase unit sales if the $65 is not too price sensitive. On the other hand, if it's extremely price sensitive, you actually might get a reduction in unit sales. So this is the range that you're talking about right here. I think you can handle the cell-based formulas pretty well, but so I'm just going to focus on the items that are but new for this particular chapter. And we're going to start with the contribution margin ratio. So that would be the contribution margin right here divided by the selling price. And so you notice the contribution margin is like it was last year, 25%. The next one is the variable expense ratio. So we're going to take the variable expenses per unit divided by the selling price, and that gives you 75%. So that's the same as last year. Now for the break even in unit sales. Let's see, we're going to go up here to the fixed expenses, and we're going to divide it by the contribution margin per unit. And so we've got a figure that's a little bit different from the previous year, but not too bad. How about the break even in dollar sales? So we're going to take the fixed expenses again and divide it by the contribution margin ratio. And we end up with this figure in dollar sales. Okay, how about the margin of safety in dollars? Let's get the unit sales up here times $65. So that'd be the selling price. And then we're going to subtract from that the break even in dollar sales down here. We've got a figure that's quite a bit higher than this number right here. Okay, the next thing is how about the margin of safety percentage? So we're going to take that number there and we're going to divide it by, and I'm going to put it in brackets, that number times that number. And so we got a margin of safety percentage of 26.4% right there. How about the degree of operating leverage? We'll take this number right here and divide it by the net operating income right there, and that gives you the degree of operating leverage. Basically, you would do the same thing for the low amount of unit sales of the 15,500. This is an analysis. And so you can see from the contribution margin ratio, those are the same. Variable expense ratio, those are the same. Break-even point, pretty much the same. Break-even in dollar sales, those are pretty much the same. So those are not particularly significant. But look at the margin of safety in dollars. Here, it's a lot better. This is a whole lot worse. How about the margin of safety percentage? This is better. Look how bad this is. And the degree of operating leverage. This is very good right here. This is very risky. This is the kind of stuff that makes marketing managers scratch their head a little bit. They sure do want to avoid this low part if they can possibly do it. They'll start out for the first couple of months. If the selling price is too price sensitive, they'll more than likely drop the selling price. I hope you have enjoyed this worksheet analysis.